lot to kind of go through. We started really, a week ago with quite a lot of bullishness. Definitely from my side, as we kind of started, it was post kind of G20. If you recall, we were up almost close to 200 basis points on S&P kind of futures. I think the Nasdaq 100 was well kind of over that, and there was quite a bit of euphoria, which pretty much crashed and burnt within kind of 48 hours, given just that hectic kind of move that we had last Tuesday. Given the fact that this is the last kind of macro Monday of the year, there's quite a bit to cover. I'll try and keep it a little bit more longer kind of term, but we'll of course kind of cover into kind of year end, and we'll have a bit of thoughts on how 2019 is looking, and post that we'll kind of go back and forth, see if there's any kind of Q&A or anything that people want to go down into in a greater detail, so to speak. But quite a lot kind of going on, as has been very much the case for this entire quarter. So let's see how we kind of get on. As always, these are solely views and opinions, not trading nor investment recommendations. Everyone should always do their own work at the end of the day. So, a lot on last week. We had a public holiday on Wednesday, which was potentially a little bit of a relief given the minus 3.24% that we saw, and actually the S&P kind of being sold. We had this huge arrest of Huawei CFO, who, if you don't know, is you could, I guess, say part of kind of Chinese tycoon kind of royalty. She is the daughter of the founder of one of the biggest private technological companies in China, Huawei, which has well over 40 billion US dollars in revenue. So huge conglomerate that's been around for decades. And of course, we've also had these tariff man tweets, which has done wonders for those that have had kind of a bearish skew. So kudos to that kind of viewpoint. Worth noting, we also have had dovishness coming out from the likes of the Bank of Canada, as well as the RBA, who may have already gotten wind of the GDP print that kind of came on towards kind of the back end of last week. I had a big miss on Australian GDP at 2.8 versus a 3.3 that was expected. It's worth keeping in mind that econ leading indicators basically from the previous month was showing quite a healthy kind of bounce back. We saw especially US ISMs coming in 59.3 versus 57.5 on manufacturing, and also for services 60.7 versus 59.1. These were also above the previous, so i.e. not just beating expectations, but trending back up. More importantly, we saw beats in the Eurozone. Germany, as you know, this is kind of where we've seen the most amount of kind of slowdown and weakness kind of globally. And even on the KAIX and kind of PMIs, beats on China, which was quite surprising to the upside, if you will. On fixed income, very much official. The signals that we were seeing from the 10s breaking lower has now been led the 30-year bond to kind of capitulate. We're sub that 326, which is kind of the line in the sand for my upward kind of calls on yields. So that's definitely been being closed kind of down from that kind of viewpoint. A really big move lower. I think we were around 331 towards the end of last week, and now we closed at 314. Huge move down. We're 284 on US 10s. On the FX side of things, weaker week definitely for the dollar. On a US dollar kind of basis on both euro and yen gaining versus the USD. At the same time, we're sitting on quite interesting levels on the likes of obviously cable, which we'll touch on later, at these kind of 127, 26 kind of levels, and also seeing some very interesting moves in Aussie, Kiwi, which potentially could be retesting kind of multi-year lows. Just as I say that, I just realized I actually don't have these two charts, but maybe it's something we can delve into a little bit later post the chart walkthrough. Commodities, again, OPEC finally did meet. They seem to kind of agree on about 1.2 million cut in oil supply. This basically led us to the first decent week that we've actually had in WTI and Brent crude, up kind of 3.7 on Brent crude, 3.3 on WTI. This is the first time like in months really that we've had a very big week. And we'll see gold breaking out, and we have quite a few gold charts with a few kind of also ETFs and names to kind of just highlight that could be potentially worth playing on, especially if you have a dovish pause to potentially slow down view on kind of the Fed. We could be in for a little bit of a run here. Granted, the caveat there is it's been very hard for catching kind of trends apart from maybe a few kind of FX crosses. The other kind of asset classes have been very, very, very tight. With that said, obviously, if you were short US 10 from 326 or US 30s from 370, you've made an absolute kind of killing. Equities very much kind of a sea of red, as you can kind of see here, very much skewed towards kind of the domestic, or should I say, developed kind of markets, if you will. A little bit of green once you kind of get into Asia and EM. But again, a lot of this could also be that they've just kind of taken a lot more of the pain than most people are. And what was also huge was this huge kind of uplift that we had in volatility, almost 30% higher in the VIX to 2323, and ditto on vol in bonds, the MOVE, and again, credit spreads continuing to kind of move up higher. What's interesting is, credit spreads, even though we've had a big run up, they're still nowhere close to, let's say, some of the levels that we did get to towards in 2016. So interesting kind of food for thought. There's actually no caught piece, given the fact that due to the state funeral last week, they have delayed it till Monday, and that was which is really odd to me because the state funeral was on Wednesday. But anyway, whatever. So catch up with that with Ola later on. I just wanted to put a few charts here on G10 and emerging markets. This kind of, we're going to look at just the last week, and then we will look at basically the period since that September kind of 26th hike, where I think we were at the most hawkish ever with this Fed in regards to kind of the comfort of what Powell was saying, and of course since then we've seen quite a little bit of a U-turn. I wouldn't call it a 180, but definitely a dilution in how hawkish and how strong this Fed was kind of posturing up to be. So this here is just EM versus US dollar, and this is obviously worst performing here against the dollar, and this is best performing against the dollar. Interesting to kind of see kind of the moves. This is just kind of last week. This here is same kind of period, but this is G10. The NOK finally having a very, very good week versus the dollar, as you know, given the 2 months that oil is being absolutely obliterated. The NOK also was getting very much kind of the same, a little bit to the same extent on the loonie, but nowhere nearly as bad as was the case there. Same idea. Now this is bigger, so this is since the 26th of kind of moving into that Fed, and we've actually seen the biggest outperformer versus the US dollar has been the Kiwi on a G10 basis. Least has been the NOK. And I thought what would be interesting is maybe we go back over that same period and watch G10 versus the Kiwi. And here again, you can see it's the NOK, Danish kroner, cable, and euro who have underperformed the most versus the Kiwi. And of course, the NOK is really all about oil, euro, and the Danish krona is pegged to the euro, so these are kind of the same thing. All the issues that we've had: Germany, Italy, Spain, and of course sterling, very much kind of the Brexit kind of phenomena. This here is emerging markets again since the end of September versus the US dollar. Huge reversal in kind of the Turkish kind of lira. Things changed there quite a bit. And you can see the Mexican peso again with the concerns of the new kind of government coming in, despite it also being quite high yielding, has actually been the one that's been lagging the most. And again, big reversal in the real compared to where we were in the first kind of half of this year. So it's kind of food for thought in regards to kind of filtering potential kind of ideas of who's outperforming, who's underperforming, throwing them on the charts, seeing if there's maybe a reversal or change in trends. So this was from last week, and this was again coming off of a little bit of a high of the G20 potentially changing the very bearish sentiment that was kind of in the market. But what quickly came to pass was the lack of clarity on what was being said on both sides. And then, of course, a few days later, the fact that Huawei's CFO was arrested on the same day that actually Trump sat down with Xi, which either tells you it was highly incompetent, or maybe this is just kind of a deeper strategy of the U.S. Never having wanted to kind of made or do a deal in kind of the first place. Again, a lot of this we won't really know until kind of later on. But what Ola was trying to flag was potentially, the agri names, and here in this case, the soybean kind of complex. being potentially kind of bought as kind of part of kind of the trade agreement. What's interesting is the complex actually did close up higher for the week, gapped up higher that kind of Monday opening, so we're up 2.5 roughly for soybeans and soybean oil, a touch higher for soybean meal for the week. I'll just show you a few charts. You can see here, this was obviously the G20 kind of weekend, so we're still up on that. This one here, again, same thing. And this is soybean oil, and this here is kind of the meal, which is a little bit kind of nowhere near kind of as big as kind of a move. This could be now a case of where it looks like it may take a little bit longer to kind of play out to kind of get clarity. Maybe this is going to end up being a 20 kind of 19 kind of thing. So we could actually get a situation here where I would just expect more volatility because I could see kind of a retracement and then potentially a move back up higher once we get a little bit more clarity. But this CFO thing has really murked things up, as we will touch on shortly. So week ahead, again, next 2 weeks very pivotal in the sense of we have two of the most important central banks on the planet meeting. And by that, I, of course, mean ECB, which is this Thursday. Actually, Thursday ends up being a bit of a central bank super Thursday, but ECB is really going to be the one in focus. We also have CPI out of the likes of the US and China, and PPI out of China, i.e. how much are they maybe importing inflation to the rest of the world. And, of course, continue to kind of focus on US, China, this economic conflict. Are we going to get some kind of clarity, resolution, a die down in the noise, or will it pick up? Will Tariff Man be active over kind of Christmas with his tweets? These are all kind of things we have to think about. I've already been hearing from clients, even already this early on, just seeing liquidity and activity drop off in the market. People who don't have to participate, just moving towards the sidelines and already calling it kind of an end of the year, which, to be honest, I wish I'd done. As we got into kind of the fourth quarter, just been very, very hard for I think being kind of on the tactical side, unless you're one of these kind of intraday traders that has no problem at all reversing kind of their view on a 180. But generally speaking, for macro guys, unless you caught the trend of the yields kind of lower, it's been very, very tough to kind of play out in this kind of last kind of quarter. But anyway, central banks, quite a few from the emerging market side, from Brazil, Philippines. We will also hear from Russia towards the end of the week, but everyone else comes through on Thursday. SNB, Norsebank, which, if you recall, last time previously had tried to kind of talk down their hawkishness. That had led to a big knocky kind of sell-off, and then we'd actually call that bounce quite well. Since then, obviously, the knock is much, much lower, so it'll be interesting to see what they say now. It should still be on put now with the expectations of the next hike coming through kind of in the first quarter of kind of next year. But we'll have to wait and see. But the Naki Seki chart actually looks quite constructive for longs and bulls. But the ECB is really going to be the main event, and this should be basically when they are lowering again their purchasing that they've been doing. So this is a continuation of quantitative kind of tapering. But the big question is if we have a downgrade in actual forecasts. Now, this is, bear in mind, my anchoring bias, my consistency bias, however you want to kind of think about it. I've been saying for quite a while now that the market has been overpricing the ECB in regards to kind of expectations there. I find it very hard to not see a kind of a downgrade just given the slowdown that we've seen in just PMIs and economic data as a whole, especially in Germany. We just had our chief economist and CIO, Steen Jacobsen, just pass through Singapore on Friday at a client event, and quite bearish on Germany, him and our colleagues in Europe, given the state of kind of autos, where we are in kind of the global kind of cycle. I believe it's something like 15% of German GDP is tied to autos, and you could imagine how much of Europe is tied into that kind of 15% of German GDP and the whole auto kind of space. And the point is, if Germany is really keeling over, if the last quarter was not a one-off, you have to bear in mind that it's tipping over when we are basically still very much record low rates in the Eurozone. So that's quite a bit of a scary thought, and something that he was flagging that no one is really talking about, and that was the potential chance of a German recession in 2019. So food for thought out there. and especially for those of you that kind of look at the auto space. And of course, a lot of these autos are trading exceptionally cheap and at great kind of dividends. So, for blue chip people that don't mind holding things through cycle, they're definitely worth a look. And potentially, if Steam is right, maybe perhaps could get quite a bit cheaper, right? But ECB is really going to be a key event. Does Draghi downgrade forecast, or does he maybe play a save the face game and look not to kind of change anything? Fed speakers, I couldn't find any. It should be the blackout, given that they are due to meet not this Wednesday, but the following Wednesday, which will be our very early Thursday, Asia time. So, officially it's deck 19th, but it'll be our deck kind of 20th. Econ data, there's a theme of flash PMIs. We already covered CPI coming out of the US and China. And the next kind of key thing really to kind of highlight here is, of course, UK Tuesday. One of the things that also happened last week was for the first time ever, a government in the UK, I believe, being held in contempt of Parliament, given the fact that they didn't release this report, which was basically dictating the potential consequences of Brexit. So there's going to be a vote from the House of Commons on Theresa May, as well as the implications of that with Brexit. It's interesting, as I was saying, we have 65% implied vol for break evens for cable tomorrow, which basically at these kind of 127.24 levels suggests a range of 128.06, 126.41 to kind of the downside. I don't know, when I was looking at kind of the charts of cable, the downside to me sounds like it could be a lot worse just from a technical kind of perspective. But that's just me from that kind of side of things. I don't think there's that much support because we're trading close to kind of year lows until kind of 124.50 at the end of the day. So just some other stuff to kind of keep in mind there. Draghi will again also be speaking on the 15th, and we'll have RBNZ's speaking on a Wednesday, right? So we covered ECB, we covered UK here as well. The China-US, I think this is again going to be something that's going to carry on into kind of next year, especially as we kind of get into the Christmas kind of, end of year period. People kind of obviously have families that go away, especially kind of in the U.S. They don't have that many kind of vacations at the end. It's hard to see a resolution coming through any time. I wouldn't be surprised if we have some things that kind of complicate matters also kind of coming through there. So it's very hard for me really to talk about. Let's maybe do. Yeah, okay, let me just, before we kind of do kind of thoughts on 2019, let me just cover what I didn't want to cover last week because there was still a lot going on. This is just from a recent trip, kind of a color in Dubai. I know a lot of our family offices and clients that kind of come on have, interests in businesses globally, as do a lot of our kind of hedge fund and asset management kind of clients. They have global mandates, so it's always interesting sometimes for them to see different things. So I was at a Wealth Summit and meeting, obviously, clients in Dubai, global macro, multi-strategy folks, very long only also folks, not so kind of hedge fund or tactical near-term kind of driven. And it was kind of interesting because also one of my best buds has been in Dubai for plus 10 years. So Dubai basically is in the middle of a property slump. This is kind of something that's very, I think, kind of thematic to what's happening kind of globally. It's been tanking for a while. There's no real end in sight. It's kind of the classic situation of things really just never digested post the last crisis. I mean, that's an underlying theme in a lot of places globally. As one of my very switched on friends and one of the best independent thinkers I know said, every play in Dubai ends up being a property play. Now, the paradox is they have the Expo 2020, so you're only going to get more supply as the construction market is still very robust and everyone's very, very kind of bullish still. So that just means more supply coming online, and you're actually even seeing the main state property player in Dubai basically turning their assets, or should I say their business model, so they have a very asset-light business model, i.e. selling their buildings and just turning around and managing them. So I thought that was just an interesting kind of trend. in regards to kind of structural kind of decline, if you will. Economy has been going sideways for a while, and obviously it's been pegged to the U.S. dollar and U.S. Monetary kind of policy, and been suffering not just headwinds from that, but also just from places where it's historically gotten a lot of wealth and spending. So be it Turkey, be it Russia, be it Saudi Arabia, Qatar, Iran, all of these countries have had their shares of shocks and issues over kind of the recent kind of 2-3 years. So this is something that has also impacted the region. Spoke to a few family offices and dinners that we had there, looking to actually diversify out of the region, asking questions about Asia, and we still kind of have this over reliance kind of in obviously oil from that area of the world. And someone was actually highlighting this could be maybe the first year in quite a while where you actually have expats as a whole net migrating out of Dubai, which I thought was quite interesting. It was also worth noting that as Saudi Arabia is opening up, while structurally long-term positive for the region, in the near term it doesn't do Dubai actually any favors, because Dubai becomes less of a draw as more things become available in Saudi Arabia. Obviously, a lot of questions there on oil. At the time, we hadn't had this bounce that we just kind of got last week. We hadn't had the OPEC kind of moved to cuts. A lot of questions on Saudi and U.S. relations. My point there was, given the fact that Trump has cut off Iran for now, the U.S. has gone from, in the Obama administration, having two parties, key parties that they could turn to in the Middle East, to one. So in many ways, they really joined kind of in the hip, despite what happened in Turkey. So I would still wait to see if we do get something maybe from the Senate next year, but it seems like it'll be very, very, very hard to kind of do really anything kind of too concrete, at least in the moment. There's a big move towards empowerment, inclusion of women in the region. I had the privilege of speaking on women's kind of panel there. So any entrepreneurs, people looking to kind of play that theme, I think that there's huge opportunities. Also huge opportunities for offering diversification away from the region. A lot more people open to that rather than actually investing in the region. And a lot of startups and entrepreneurs actually struggling to get financing out there. This is actually something that some of you may see in different parts of Asia, where actually people have to go, like in some cases, all the way to kind of Silicon Valley, just to get the funding just given kind of education of kind of the local market, and where there's kind of first or second kind of generation kind of wealth at the end of the day. And I think also at some point, places like Dubai are very similar to places like Singapore and places like Hong Kong, um, and they have to get much more kind of competitive to keep attracting structural long-term capital, as well as kind of expats. So changing domestic kind of steps, kind of staying, residency, and so on and so forth, which is still something that's an issue kind of out there. But anyway, food for thought, and maybe something that you can connect with internally in your businesses, or in your relationships out there that could be of use. Moving back, 2019. Now we probably get towards the end of the year, and as a client actually was saying, we always say this. We always say, "Oh, next year it's going to be so hard," and maybe we're just kind of going through that same thing now. Now, I think you have to bear in mind that the sentiment is extremely poor and bearish at the moment. I thought that we were potentially going to be able to change last week, given the G20, but even that wasn't enough to do it, given, just to be honest, the very poor execution from both sides, right? Now again, it's worth bearing in mind that economic growth is not falling off a cliff. I think this is something that people keep missing and forgetting kind of about. Feel very, very kind of comfortable on that. Yes, we are slowing down, but yes, we've also been growing at the best level in well over a decade, as well as the most robust level in a decade, and by that I mean spread out growth, across the globe, right? I think for global macro and trying to catch more medium to long term kind of trends, you got to take a take on the Fed, U.S. fiscal stimulus, and U.S. China relations. and they are probably the toughest in regards to trying to figure out this one. This was probably the easiest if we were to get it, and the Fed could have implications if we do get a U.S. kind of fiscal stimulus. So I think the simplest thing, again, as I kept saying, as in, especially being a macro guy and wanting, shelf kind of trades that last for a while is if we get a big new U.S. fiscal stimulus in kind of the first quarter. So the Dems take over the House in Jan. There's already signs that came through over the weekend of potentially a $300 billion infrastructure bank that would be funded by bonds that would basically go to pension funds in states. In the U.S., there'd be plus 200 basis points on 30 years, minimum holding period actually of 10 years, not 40 years here. But basically, those yields and given just how yield starved this world continues to be, especially if we are towards the end or towards the slowdown of the Fed. I could easily see this being extended. I think it could be oversubscribed many times. If you recall, we had that ridiculous, at least in my viewpoint, perpetual bond out of Argentina that was oversubbed so many times, and the yield, if I recall correctly, was nothing special at all. I think this big kind of fiscal stimulus could be strong enough to change sentiment and could be a lot more supportive of global growth than a simple kind of domestic tax cuts. So this is definitely something to watch. It definitely would be a key thing really to put on your radar kind of for the first quarter of next year, because that's kind of the underlying part of, I think, what the U.S. markets are struggling with is we've had this huge fiscal stimulus that's kind of gone into earnings this year, and just like when you have a huge kind of bonfire to keep it running, you have to keep adding more wood kind of into it. So are we going to get more wood, or is we just going to have to get used to the fire and this heat being much smaller than it is? It's the number one thing that I'd watch out for, because it could really open up, let's say, the next kind of trend for the next 6, 9, potentially even 12 months. On the Fed, we've seen a pretty big reversal from post September, Powell basically saying far from close to neutral, to recently him saying we're actually near, in just a space of a few weeks with actually no additional rate hikes really being seen between today and September. And to be honest, no massive degradation in U.S. data. Yes, we've had pullback in PMIs. Yes, we've had some pullback in inflation. But by my point of view, just like how we had huge accelerations in kind of the summer, I think it's just kind of the natural kind of trend of things. But this is a big one to make. You may just sit on the sidelines and see what comes through next week. I think the market is definitely looking for a one and done Fed. Some are even looking for no hikes next week, which I think we'd have to basically sell off by another 10 to 15% for that really to be a risk. Sub 2,500 on S&P and yields at 250, etc. So I just don't really see that happening, but it definitely is a key risk, just given how poor the sentiment is, and as we saw last Tuesday with the minus 3.24% on S&P. I think the U.S.-China is just a lot more opaque. It's not going to be something that goes away in 2020 if, let's say, Trump leaves. And I think if China's thinking that they could be making a really big tactical mistake. I think this is something, especially on the IP and intellectual property and technology issue, is a big sticking point for both the Dems and the Republicans, and it's going to be something that's going to be very kind of thematic to the relationship. And as we said previously, I just don't see how it's solved anytime soon. The risk now from the arrest of Huawei's CFO is that this continues to escalate. Maybe we see China doing the same back to U.S. executives or U.S. companies. What makes this much more complicated is it now becomes a face thing. And Xi still has, 1.4 billion people whose pride he needs to carry and uphold. And, this is really kind of actually also where it started to get dangerous at the start of the year. So maybe licenses being revoked from U.S. companies. There's a few U.S. Macau names. There could be a lot more pain to come. Remember, GM sells more cars in China than in the U.S. I believe something like 4 million to 3.5 million. So it could definitely get a lot uglier. And I still feel like the U.S. has still not seen much of the pain. Most of the pain so far has been on the China kind of side of things. And maybe if we continue to sell off on the equity kind of side, we'll get a more friendly kind of tariff man, but I'm quite skeptical of that, right? I think the classic view is, the Fed stops or pauses. We now are basically pricing in kind of one hike for next year.